Hey everyone, welcome back to Corporate Decoder, the place where we try and figure out if a company is playing 4D chess or just fumbling around in the dark. Today, we're re-diving into a filing from Boxlight Corporation, and let's just say they are cooking up something interesting. So, what is the big news we pulled from this latest report filed by Boxlight Corporation? Well, it looks like they've inked a deal that could bring in a significant chunk of change, and we're going to break down exactly what that means for them, and for us as investors or observers. If you want to get these kinds of insights straight to your feed, make sure you are subscribed. And hey, we've got a fantastic community over on Discord. Link in the description below where we talk all things corporate finance. Alright, let's get straight to the point. The main event here is a sales agreement that Boxlight, or the company as they call it here, has entered into with AGP, Alliance Global Partners. This agreement is essentially a way for Boxlight to sell its class of common stock shares. Pretty standard stuff, but here is where it gets interesting. They are setting themselves up to sell shares worth up to a maximum of $4.8 million. Now this is like a direct sale of the company to one buyer. Instead, it is an at-the-market offering. Think of it like this: instead of going to a big investor and selling a whole bunch of shares at once, we're going to slowly offer these shares on the open market, kind of like putting them up for sale in batches. Whenever the conditions seem right, this allows them to raise capital without drastically affecting the stock price immediately. Now, who is doing the selling for them? That is where AGP Alliance Global Partners, or the agent, comes in. They'll be acting as a sales agent, and for their troubles, they get a commission, which is set at a firm 3.00% of whatever gross proceeds they bring in from selling these shares. So, for every $1 million worth of shares sold, the agent pockets $30,000. It is a pretty neat deal for them. Boxlight also agreed to cover the agent's expenses, and there are some caps on that. LL reimburse reasonable out of pocket costs, including legal fees, up to $60,000 initially. And then there are provisions for future expenses related to this program, like refreshes to the filing, which could add up to another $20,000 each time. This is all pretty normal for these types of agreements to ensure the agent is properly compensated and their work isn't costing them money. So, where are these shares coming from? Well, Boxlight already had a shelf registration statement filed with the SEC, which is like a pre-approved way to issue and sell securities over a period of time. This filing we are looking at today is basically a supplement or an update to that existing registration, specifically for this at the market offering. The initial registration was filed back in January and became effective in February of this year, 2025. One crucial thing to understand about this deal is that Boxlight is forced to sell all $4.8 million worth of shares. They have the choice to sell them or not, and they can pause or stop the offering at any time. This gives them flexibility to act based on market conditions, their own cash needs, and other strategic factors. The offering will end when they've sold up to the $4.8 million limit, or when the registration statement expires, or if either party decides to terminate the agreement. As part of this process, they've also included an opinion from their legal counsel, Kilpatrick Townsend Stockton LLP. This opinion basically states that the shares being offered are legally sound to be issued and sold. It's a standard requirement to ensure everything is above board from a legal perspective. Now, looking at the big picture, this move sets Boxlight up to potentially raise a substantial amount of cash. This kind of at-the-market offering is often used by companies that want to maintain flexibility in their capital raising, especially if they anticipate needing funds for growth, acquisitions, or to weather potential business challenges. It is a way to tap into public markets without a big fanfare and price impact of a traditional secondary offering. For investors, it means there will be more shares potentially coming onto the market, which could dilute existing ownership stakes. But it also signals that management believes the current stock price is reasonable enough to raise capital. So, what does this mean for Boxlight? On one hand, it shows they are proactive in managing their finances and are prepared to seize opportunities or address needs as they arise. They're giving themselves a financial runway. On the other hand, it is a reminder that they might have upcoming capital requirements or are looking to bolster their cash reserves. In the world of business, having cash is king, especially when you are navigating evolving markets. This agreement provides them with that crucial flexibility. It is not a guarantee they will sell all that stock, but the option is there, and that is a pretty strong signal. It will be interesting to watch how they utilize this facility, and if they indeed raise the full amount. We will definitely be keeping our eyes on their future filings to see the impact this has on their balance sheet and their strategic initiatives. What is your take on this move by Boxlight Corporation? Does this signal strength, or is it a sign they anticipate needing a cash infusion soon? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really does help the channel out. And subscribe if you haven't already for more of these corporate deep dives. And don't forget to join our growing community on Discord. Link is in the description. Thanks for watching, and we'll see you in the next one.